Lira Mota with us. Lira will present the paper, Should Information Be Sold Separately? Evidence from MiFID 2. Lira, again, it's a really pleasure to have you today with us. You have, before you start, as usual, we give a brief explanation how the seminar works. You're gonna have between 40 and 50 minutes. All the questions will be made in the end, asked in the end, unless you have the audience have some specific topic to clarify. So again, it's a pleasure to have you with us. And without further ado, the floor is yours.
Hello, everyone. So first, thank you very much for the opportunity to be here. It's very nice to see those faces that I don't see for a long time. And today I'm going to be talking about information. This is a joint work with Ifon, who was my colleague at Columbia Business School. To start, let me talk a little bit about information. We all know that information is key to financial market efficiency. But the problem is how to produce information. Information is difficult because
you're not sharing the screen. So
I am not.
Are you? No.
Yes.
Huge sharing.
Yes. Oh, sorry. Apologies.
I am not. Can you see?
Yeah, that's fine.
Yes.
Okay. I should be how to sell information. I'm here, right?
Yeah.
So. Okay, perfect. So we were talking about selling information, right? So what is difficult about selling information? Usually we think about information as having a very high cost for producing, but it's basically zero cost to disseminate. So marginal pricing is basically impossible in this market. Therefore, how you pay for information becomes an essential question. And this will create not only incentives to agents to produce efficiently, but also how much information is going to be produced. In practice, the market has adopted one strategy to sell information, which is to bundle with other services. This is true here in the US, this is true in Brazil, and it has been true for a long time, at least from the 50s. This is called bundling, okay? Bundling usually means that you, as a fund manager, for example, you're going to get services from a brokerage house, and in exchange for placing your trades in this brokerage house, the brokerage house will give you information for free. I'm going to put in quotations information for free because of course it's going to be the cost for production information is going to be included in the price for trading, but you don't pay for this directly. This is known as soft dollars. The problem here is that the end investor, you are the fund manager, you're paying, you have an end investor who doesn't know how much you're paying for information. And why he doesn't know? Because the fund manager has the right to discount from the fund performances the trading cost. And this trading cost now includes also the price for research. So this is, like I was speaking, the bundling. So you are buy side, you pay in commissions, you receive trading and also research information and information to trade public firms, okay? The good thing about this is that for long has been shown, this is an old paper by Varian, that if you have investors with heterogeneous preferences, one way to maximize revenue is by bundling together two services or more services. So now brokerage houses can maximize revenue and potentially cover this fixed cost of information and cover more firms, for example. On the other hand, here you can already see that there might be some conflicts of interest, right? The first one is that buy side might have some private benefits from buying information from the sell side. If that's the case, buy side will pay for information that is not optimal for the end investor. Another problem here is also that since the incentives here is bundled together with trading, one thing that analysts might do is to try to maximize the amounts of trading that your brokerage house is making. This is usually called hyping. And there is a very large literature about hyping and how information or analyst research can be biased due to this conflicts of interest. With that in mind, with mainly the conflict of interest brought by soft dollars in mind, the European Union, and mainly, that was a long discussion and it was related to a lot of issues, but in the end, Europe was able to pass this regulation called MiFID II. So Europe and the European Economic Area was basically the first region to say you're not allowed to bundle anymore. After MiFID II, now the buy side it is required to pay for research here separately from commissions. And this is called unbundling, okay? In this paper, before I go to this paper, this was a major change. And actually it was on the news for more than a year. And people were saying that this would destroy the analyst research. And others, and of course here who would benefit most for it, who are the people who don't want to pay for this high trading costs. They were trying to defend it. But in general, it was very controversial. And it was a very peculiar environment in which the European Union was able to pass this law. What we ask in this paper is very simple, is what are the consequences of unbundling research from transactions? This is important because bundling has been a topic of research for a long time, but there is no, like I was talking before, there is no time series variation in the methods of paying for research. And the MiFID II brings us like this event that we are able to study this question. Specifically, we are going to ask what happens to analyst research quantity and quality after unbundling. And more importantly is what are the mechanisms that are driving the results? Answering this question is very important because MiFID II, in the end of the day, did not only impact Europe, but impacted the rest of the world. One case here was in the US, that after MiFID II, the US SEC started to discuss whether this would be optimal to be implemented also in the US. And recently, I talked to a person who has a direct platform to do analyst research. So basically, he wants to build the bridge between research and firms. And he was talking about the case of Brazil. So even in Brazil, this regulation is changing the way the regulators is thinking, and also how the lobbyists are thinking about how to pay for information. Going directly to the paper, this is a simple paper in terms of methodology. We are going to use a diff and diff, where our treatment group is going to be the European area, sorry, the European firms. And our treatment group is going to be the US. We find that the unbundling impacts research quantity by decreasing research quantity. The decrease is actually 8%. So on average, European firms lost 1 analyst compared to the US. We also find that quality improves. This is very interesting. So even though quantity is decreasing, the quality of research that remains being produced increases, and increases by 19%. We are going to argue that this result is driven by an enhancement of competition in the market for analyst research. This is because now, when fund managers are more selective in what type of research they're buying, in order to cater this more selective demand for analyst research, the analyst now becomes more worried about the quality of research that they are producing. And therefore, those analysts are going to start to produce better research, okay? And we test this using 2 tests, like within analysts and also across analysts. And we find that within analysts, the analyst becomes more precise in their forecasts. And we also find that analysts who drop out are actually the worst analysts based on a ranking that I will be very clear in a moment. The conclusion of our research is that unbundling is controversial in the sense that even though it decreases quantity, and this might have welfare effects, it increases quality. We view our research as a first step, and unfortunately, we are not going to have a final answer whether this is good or bad to market efficiency in the end. But it's an open question, and we think it's a very important question. Contributions for the literature, I'll go rather quickly here, but very, very naturally, this research will relate to analyst behavior and how to generate the right incentives to analysts. And I just want to mention one result that is very, very preeminent in the literature, which is the indirect types of competitions in the bundling system. So some research has shown that peer pressure, for example, is a way to create competition among analysts. But this literature usually finds that a decrease in quantity causes a decrease in quality. That's because you decrease the peer pressures. Our result is very different because now we have a direct competition among analysts, and now the decrease in quantity here is actually an outcome that in order to survive now, you need to produce better research. This is a direct link to theory, where there are lots of papers that think about how to pay efficiently for information. And we are basically saying that there is not only one dimension of paying for information, because quantity and quality can be decoupled due to the payment schedule for information. And finally, we are one of the first papers to study the impact of this regulation. There are other 2 papers right now, but we are also very specific in understanding what is the mechanisms that are driving the results. Now going directly to the paper, I will go very quickly to the regulation because you need these in order to understand the empirical design. Then I will explain the empirical design, and we are going to the results. I hope to have some time to discussion in the end. MiFID 2. MiFID 2, as I told before, affects the euro area, and very importantly, it affects the buy side. The buy side is required to separate the payment to research and to trading, okay? So it's the buy side, it's not the analyst directly. But since the buy side now has to report those prices, it basically means that the analyst here, the sell side, needs to charge separately for those 2 services. The buy side, the fund manager here, can pay for information in 2 ways. The first one is that they can use this research payment account. So they will say to the end client that they are using the money and how much they are using of this money to pay for research, or they are going to internalize the costs. It ends up, this was not ex ante known, but it ends up that it's very difficult to justify what you're buying for information. So from surveys, we know that the majority of the fund managers decided to internalize the costs, and they are using, basically they're discounting the cost of information from the P&L. As a timeline here, MiFID, as I said, it was a very long discussion until it took place. It was first discussed in 2014, but it was only implemented in the beginning of 2018. So here is our hypothesis, and also relates on how the market and all the news were talking about unbundling. Our hypothesis, the first hypothesis, that the research quantity decreases. And the reason here is simple. Now, the fund managers cannot blindly pass the cost to end investors of research. So the amount of resources that can be allocated to research decreases. That being so, we think that there is less amount of money that is going to be allocated to research. Okay, so this justifies our first our first hypothesis. Our hypothesis on quality, I'm sorry for this. Our hypothesis for quality is ex ante unclear. That's because research quantity decreases. So this idea of peer pressure would also imply that it decreases. But making a research a standalone product enhances market competition. And therefore, we think that this would cause research quality to increase. Let's go directly to the empirical design. We use very standard data sets. The first one is EBIT, which just collects analyst forecasts for a long period of time and a large cross-section of firms. We use DataStream and WorldScope to get firms' fundamentals, and I'll be very specific why we need. And our data covers annual data, and we use annual data just as a note, because European companies, different than US companies, they're not required to report quarterly. And in some cases, it's very selected. There's going to be a selection bias if you use quarterly reporting. So it's annual from 2014 until 2018. The empirical design is a diff and diff. Our treatment group is firms that are domiciled and listed in Europe, and analysts who cover mostly European stocks. Our control group is going to be the US, so firms that are domiciled in the US and analysts who cover the most US stocks. As I said, MiFID II does not affect directly the analyst research, right? The brokerage, it affects the fund manager. So our hypothesis here has to be that the majority of the firms, the majority of analysts who covers mostly European firms are going to be the most affected ones. And it requires a certain home bias. And this is true, as you can see from this plot here. The proportion of US firms in the analyst portfolio is basically concentrated either on US or Europe, okay?
I have a question here. I don't know if I'm violating the rules because I have, but you said that that this thing will not affect the brokers, but the brokers choose. They could just reduce the brokerage fee, but they choose to offer soft dollars. So it seems that something is going on. Why would they? Because they could anyway reduce brokerage fee instead of giving soft dollars, and they chose to have this form, and now they cannot anymore. They are constrained. If the brokers are constrained, they should be worse off. At least at first, my first intuition.
No, definitely. So maybe I misspoke. What I meant to say is that the brokerage houses are not directly affected. So the regulation of MiFID II is not regulating brokerage houses, it's regulating fund managers. But because fund managers need to separate the costs for research and trading, that constrains brokerage houses to give a price separately to research and trading. And this is how it's affected. But it's important to understand here, because the fund manager is domiciled in Europe, and these brokerage houses could potentially be a world company that is not fully affected, right? Or analysts that are not fully affected. But in what I'm trying to say here is that analysts are usually concentrated in each area. So the analysts who are concentrated most, I shouldn't say concentrated, let me be more specific. Analysts who cover mostly European firms are going to be the analysts who are going to be most affected by MiFID II. It's very weird to not see faces, so I don't know if I'm answering well or not, but am I clear, Bonomo?
Yeah, yes.
Just
Okay.
one, I guess an important clarification here, maybe is, it affects only funds based in Europe, yes? So fund managers based elsewhere, they can still, actually, if you work for Santander in Spain, you cannot get research for free. If you are in Brazil, you can. Even within the same firm. Actually, it depends on.
Exactly. So it depends whether this fund manager is based in Europe or outside of Europe. So if you're Santander based in Europe, now you need to charge your end client separately for trading and research. I hope I'm clear now. And I think this is very, very important, and it's going to be related to the recent evolution of MiFID, because even though MiFID was intended to affect only Europe, because we have these global companies and it's very difficult to have different models, business models, it turns out that unbundling is becoming more and more common, and it started to affect other regions as well. Okay?
Okay.
As we said, as we're discussing here, the identifying assumption is that the exposure of firms and analysts between the two continents are different. And this is based on the idea that MiFID II regulates asset managers directly. This is unobservable, but local investors tend to hold local stocks, and analysts covering European stocks are more likely to serve European clients, and therefore they are more affected. And of course, the other identifying assumptions, parallel trends. So in absence of the regulation, we expect the two regions to behave in the same trends that they were behaving before. Let's go directly to the results. The first result is the impact of firm level analysis that we are going to call. Let me be very specific what I mean. I will have an outcome variable. These are going to be proxies for research quantity and for research quality. J here is either Europe or US at time t. And then treatment group is 1 if you're European, here in European firm, or European analyst. Sorry, we are in firm level, so European firm. And the pose is after MiFID II, after 2019 or before. We have a bunch of controls. Those controls are very standard for this literature, and we're going to have time and firm fixed effect. Quantity, for quantity, we are using coverage. So this is the number of analysts covering a firm at each time, okay? And a number of unique analysts. And for quality, that's a more difficult measure, because quality, as you can think, there are many dimensions of quality. We choose to use forecast errors. This is the absolute difference between earnings forecast. So each fiscal year, we are going to use the fiscal year most recent analysts forecast before the announcement of the earnings. So this is this variable here, actual EPS, the mean of the forecast minus the actual earnings per share. So this difference, which is a forecast error, we are going to call our quality measure. Of course, analysts produce other services other than just forecast, and that is communication directly to the company, or a phone call that you ask analysts what is your view about this stock or this industry. Unfortunately, those things are very hard to measure, and we are going to rely on a more quantitative measure, which is earning forecast. But we are going to try other measures. If I have time, I will show you afterwards. Let's go directly to the first result. So maybe I'll show you the plot. I like the plot more than the table. Here you can see the blue line those are the number of analysts per firm for Europe. They are just normalized for the pre-period, and the red line is the US. As you can see, there is a secular trend of decreasing analysts, that there is some research about it. But what is most important is that after MiFID II, there was a sharp decrease of number of analysts covering US firms with respect to the US. One thing that I want to call your attention here that I forgot to mention is that you can see our treatment line here is 2017. And the reason is because you're using fiscal years. So the fiscal year 2017 actually comes in the firm's fundamentals is released in 2018. So this is basically the first year that analyst forecast is going to be affected by MiFID II.
Lira, let me ask you a question, a brief question.
Sure.
Any reason to explain why the number of analysts in US was stable? Because there was a downward trend and interrupt exactly in 2017. Anything come to your mind to explain that?
I think that's more of a plot issue, but what is true though, and I'll separate these plots in a little bit. There is a sharp decrease both in the US and in Europe of coverage of small firms. And this is true for both. This is true for both regions, not only for Europe. And this is usually related to the idea that this industry was suffering actually a lot from technology. They say that I read a lot in the Times saying that it's suffering from technology evolution, in a sense that the majority of firms are trying to contact directly investors rather than going through analysts. This is a possibility. I don't know, but this little kink that you see is basically only related to the small firms.
Okay.
Okay.
And when you say small firms are the one covered, but not the broker house providing service, right?
No, here I'm talking about firm level. So I'm talking about firms. To be very specific, I'll go over a little bit in more towards the end of the presentation. But here I'm talking about, I'm going to divide firms in market capitalization. I'm going to call small firms the firms that follow below the median of market capitalization.
Okay.
So this decreasing trend, well, again, it's before MiFID II, and it's not going to, we don't find any evidence that is due to MiFID II.
Okay.
But I'm going ahead of myself here a little bit.
All right, perfect. Thank you.
Okay, so the main results, going back to the table, is this one here, which is the number of analysts covering European firms with respect to US firms decreases. This number, I put here a tip note, which is, it corresponds to a decrease of 7.6%. This is on average one analyst, okay? And the forecast ever decreases. This is evidence of increase in quality, and this is an 18% increase in quality. Just as a note here, as you can see, this is not related to the quality result mainly, is not related to one subgroup, and is actually the whole distribution of forecast error is improving because the whole distribution is going to the left here. Okay, this is the parallel trends. Believe me, the parallel trends hold, and it doesn't matter on the controls, it doesn't matter on the specification. About the interpretations, we see the decrease in quantity, the total, so we think that the total amount of money that is deployed to analyst research decreases because of the selectiveness on the parts of the fund managers. But there is this improvement in quality. So analysts compete more directly in the quality domain to try to maintain those fund managers, so those clients, okay? As we think that as asset managers internalize the research costs and they are not able to blindly pass to end investors this cost, they will opt now for just the research that is actually beneficial for the trading activities, and they will opt for better research quality. And if that's the case, also analysts now, they're going to be evaluated directly by the product they're supposed to create, which is research, and not indirectly through the trading plus research. So now they have less incentives of producing biased forecasts that will just increase the amount of trading. And for those two reasons, we think that the unbundling causes this increase in quality. Of course, we can test this directly in the data. And then we have basically two specific predictions, which the first one is the analysts who stay, that will produce better information. And second, that we can look at who are the analysts who are dropping out. And to do this, we need to move now from our regressions that were at the firm level, like we were talking before, we were talking at the firm, firms that are usually most covered by European analysts. Now we are going to the analyst itself. In order to define who is an Europe analyst, we need to think about the analysts who are most covering European firms, or an analyst who is most covering US firms. And this is going to determine our treatment and control group. Okay, so let's go to the intensive margin. So here's the idea that the analysts who stay will produce better research. We're going to focus on analyst firm pairs that survive throughout the entire period. Here, my Y variable is going to be the average forecast error for analysts I across all firms J in a given year. So I'm averaging across all analysts. And of course, here the treatment group is the analysts who cover mostly European firms, and the control group is the analyst who covers the majority of US firms. Here, a little note about the fixed effect. I have firm fixed effect and time fixed effect. To be very clear, you can also get brokerage fixed effect. And this is a very strong fixed effect, because basically now I'm comparing analysts within the same brokerage house. And we think that we are killing some of the variation that we're interested in, but nevertheless, this is a valid robustness test. And as you can see, the analysts who stay within the analyst variation, the analysts who stay after MiFID 2, the forecast error decreases by an average here of 15%. The extensive margin now. We are going to ask who are the analysts who are dropping out. In order to do this, we need to create a measure of the quality of the analyst who is comparable across different analysts that potentially cover very different firms. I won't go on into the details, but basically we follow the literature. We follow this paper by Hong and Kubik, who create a ranking. And you can think that the better ranked analyst is the best analyst, and the worst one is worst analyst, but it's just a way to compare different analysts across times. And then here, the all variation will come from the cross-section, because we are going to ask how the probability of dropping out, basically to be laid off as an analyst, depends on your rating accuracy. And what we find is basically that the worst analysts, they have a larger probability to drop out than the good analysts.
Lira, you mentioned about the effect on the broker house. And what are your controls? It would be possible to control for the size of the broker house, the profitability of the broker house, some way to provide you degrees of freedom to incorporate the cross variation among broker house?
So unfortunately, profitability of the brokerage house, we cannot, because we do not, in EBIS right now, we don't have an identifier for the brokerage house. Even though we are able to say, like we have like a masked identifier that tells me that I can follow this brokerage house across time, but I cannot know that this is Santander or who is this person. So unfortunately, I cannot do this. But what we did was to try to, for the size of the brokerage house, we were asking, is it true that the smaller brokerage houses that are more affected, or is the biggest brokerage houses? And our idea, but you have to think, like our measure of size is going to be just the number of analysts that belongs to this identifier that I don't know which identifier is. And our result is that it's the largest brokerage houses are the most affected, in the sense that those are the laying off more people. And we think this is consistent with our story, because those larger brokerage houses, they usually are the biggest brokerage in trading as well. So we think that there's a lot of research that is produced there that is toward trading rather than research itself. And we think that those are the ones that are going to be dropping out.
Okay.
Okay?
Yes.
Okay,
Let me just do a sequel question of the one, because it is related somewhat. So we have several sides on this. Now I remember how this works, why this thing. The brokerage house charge a higher brokerage fee, but the brokerage fee, in fact, goes to the clients, not to the fund. So the fund prefers to get the discount that they will get in the brokerage fee, gets some free research, and then who is worse off? Who is worse off in the initial condition is the client. And now the client should be better off because the fund should have, like, the brokerage fees should decrease, and then the client and the return of the fund should increase because now it costs less to trade. So, and the brokerage house also should be worse off, like their profit should decrease. Were we able to follow these other sides of the story? Like what happens with the returns of the funds, for example? What if the clients are better off?
Okay, so it's very hard to say if the brokerage houses are better or worse off, because basically there is no data on trading commissions. And I mean, if I look at the profitability of Santander, there's so much there that I don't think I will have any evidence, any granularity in the data in order to measure the effect of MiFID II. Of course, Bonomo, that this argument that the clients are better off was exactly the argument brought up by European regulators to pass MiFID II in the first place. Though the counter argument is that there is not enough money in order to produce information. And this will give me a link to one of the exercises that we do. One of the main problems of MiFID II, and was one of the main forces that were pulling against, were people saying that the coverage of small firms would disappear. And the idea here is that if you're not able to bundle this and charge it for a large pool of investors, this price, then the brokerage house could not cover this firm at all. And this, if you think about efficiency, this is bad for the end investors, right? Because now information is not going to be produced. Funds are not going to be allocated properly.
Information not only produced by the brokerage house, no?
Of course,
if there is valuable information, the fund should pay other researchers for doing that.
The problem here is that charging like valuable information is it's difficult for me as a fund manager to go you and investor and say, look, what I'm buying is actually valid, because for many reasons, right? First, if you think that of efficient markets, this information should be already in the price, but then it basically goes back to why soft dollar was implemented in the first place. So when the regulators go back and say maybe MiFID II is not efficient as we thought before, it was exactly because they thought that those firms, they would be affected, and this is actually bad and a bad outcome for market efficiency. Though we don't find any evidence for this, so I don't want to defend it too much, because actually we don't find any evidence either. So here we divided the sample in small and big firms, and we asked, like, is it true that small firms are the most affected by MiFID II, as the media was saying, as the regulators were saying, as was the main problem of MiFID? And the truth is that small firms are not most affected by MiFID II. So what we see here is that the number of analysts who are dropping, they're dropping actually from the larger firms. So all the drop in the quantity of analysts that we're seeing is coming from the large, not from the small firms. We view this as further evidence that the analysts who are dropping out are analysts who are producing duplicated service. Let me explain this a little bit. If you're a large firm, if you're Apple, okay? Apple has, I don't know how many exactly, but has many analysts. The idea here is that any large brokerage firm will have somebody covering Apple. And a lot of this information is being duplicated. So if I am a big enough fund managers and I trade with many brokers, I'm buying this information from different brokerages, but maybe I'm not using this information. Now that I have to decide and pay for it, now I will select just the best one, okay, or the most informative one. And in this case, the large firms that has a lot of duplicated services are the one that is going to be most affected. And I would say this just to link to this recent unfolding of MiFID II, which is that after the Brexit, countries in the Europe zone, mainly France and Germany, they started to lobby against the MiFID II provisions of unbundling, and they want to go back to the bundling model, saying that this is affecting mostly small firms. That's the main argument of this reversal of MiFID II. And we should say that England was one of the strongest advocate for MiFID II. We, in our paper, we don't find any evidence of this story. We don't find that small firms are most affected, but it is important to notice that it is true that coverage of small firms is decreasing, but it's decreasing everywhere, not only in the US or Europe. Okay, I think I am right in 50 minutes. With this, I would like to conclude. This is a paper that studies the impact of unbundling on analyst research production. We find this, that is a coverage quantity decreases, whereas coverage quality improves. And we think that this regulation causes an enhancement in competition among analysts. We think that this paper sheds light on quick questions of how information should be paid, and moreover, how this market should be regulated, since there is true potential of conflicts of interest together with this issue of how to pay true information. And of course, we are extremely interested, Bonomo, in the idea of welfare, who is paying, who is benefiting, but unfortunately we didn't get there yet. And honestly, it's because the data, it's very hard to get, and we don't have like granular data on commission fees and specific partitions of the profitability of firms. Okay, thank you very much. I would love to hear your questions.
Thank you very much.
Yeah, I'll ask a quick one here before we get questions from other people. And anyone that wants to ask a question, just say something on the chat, and then we'll open the mic if it's not open yet. I guess you're focusing more on the firms and not so much on the funds. I guess one of them, Bonomo's question was, what was the effect on performance and on the clients? Yeah, so, and there are funds in the US that are investing in European stocks, and they have access to all the information. So can you do anything using that kind of information, or actually maybe the treated are not exactly the firms that are in Europe, but that are held mostly by funds in Europe, yeah, based in Europe.
Exactly.
Of course, you don't have that. Like you could have used Lion's Share data or 13F data for US funds to do that. So
yes. So in the beginning we did try, but the truth is that home bias is something that we know, that we believe, and so in the end we decided to rely on this home biases evidence, and in the end for the specific of this paper, but not a little bit stepping down of the true question, is that what we need for the different diff to work is just that the two regions are affected differently, right? Of course, that if our treatment group is affected as well, we are going to be basically underestimating the effect. This might be problematic for small firms, but we don't think that this is driving the results. On the other hand, now going back from something that we did not do, but we think it's, actually, when I started this project, that was the answer, that was the question that I wanted to answer, and I was not able. When we looked at the MiFID II, when you look at the people who were against and who were defending MiFID II, there was a very clear trend. The active fund managers, they were basically against MiFID II. And they were saying many things of like affecting efficiency of markets and etc. But all the passive industry, they were pro MiFID II. One example was PENCO, that was actually pushing for the MiFID provision also in the US. So I think this makes it's a smoking gun evidence that different type of funds or different type of fund managers will be differently affected by this regulation. And of course, if you're passive investors and you don't have interest in this research anyway, what you want is minimize your transaction costs. You are pro MiFID II because there is also a lot of evidence that MiFID II caused, I don't have the data, this is only through consultancy papers that gets out, but there is large evidence today that commission fees have decreased.
But it's also possible that these funds can get different deals because they are not interested in the research and then bundle that. Yeah, so it's something that happens as well. Yeah, so the passive.
Sorry, who?
The passive funds do not necessarily pay for the research and then bundle it, or go for discount brokers or other types of alternatives for trading. And so this may be a pattern.
Okay.
Just a comment.
No, but here is, I just want to be very clear. This is I think it says evidence, like Vanguard was also, you can find like these white papers on Vanguard on MiFID II. They're completely pro and they think that they should be the same thing in the US. I mean, I think it's very clear. We collected some of this evidence just from the news, but unfortunately, again, right now, the funds and how much they pay, this is just discounted from performance of funds. And we don't even know, there isn't data on how much funds are paying for soft dollars in the world.
Okay.
I have another question. So but I promise the last one. So you have mentioned about the controls you have used, Lira. I know it might be a minor question, but have you control for the stock market performance, which is like a proxy for the behavior of the entire broker house industry? Because if the stock market is growing, probably the broker house will hire more people to work and provide more service, but is in the down market, probably they will lay off people, and so would underestimate your true results. Have you used something like that or not as a control?
Yes. So anything that we think that is not directly affected by MiFID II, that would be included as control. So this include firms fundamentals, for example, profitability, returns on asset, and this is for the firm level. For the analyst level, we are to include all the firm's controls, plus some analyst controls, for example, the number of firms that this analyst covers as a measure of like how specialized this analyst is. And also things that we try to do, and unfortunately it's one shock, so it's very hard to say like, how would it be if it was in the middle of the crisis or if it was in 2018. But we did a lot of robustness analysis to think about value stocks versus growth stocks, like loser stocks versus small stocks, and we didn't find any differential effects across those different groups. So we think as of this as evidence that our controls are controlling for like things of course, that like if a stock is on a hype or something, we expect more analysts covering it. We think our controls are picking this up.
Okay, perfect. Well, if anyone from the audience want to ask a question, just use the chat and we open the mic.
I guess we're hearing a lot of congrats for the paper, and no more questions. So
yeah.
Guess you have time now to enjoy Italy. Right.
Nobody enjoys anything when you're in the job market, I guess.
No, good stuff.
But
we'll enjoy. We'll enjoy.
I have a question to you. So is there? I try to do some research. Can I ask questions if there is no questions? Yeah. But I try to do some research how this regulation is changing, is affecting Brazil. And other than this person that I directly talked to, I didn't find a lot of evidence. So is there evidence that there is a change?
As far as I know, as far as I know, there's no impact. And even like I mentioned the point about Santander, because I had to ask that question as well, whether there was any impact. And there isn't, like, even the international funds based in Brazil, I guess, like, if you are a fund manager here in Brazil in an international firm, actually you're not affected, even though the parent company, for example. So
got it.
I don't know if there's any trend on reevaluating that.
Because I know that Asia was deeply affected, and that's because companies like, I know from JP Morgan, for example, they don't want to have different business models for different regions. And then in the end, like, Asia was deeply affected. But again, I did not find any evidence for Brazil. So I think what you said, it should be really true. Then
maybe not in Brazil, but maybe in other places, actually, the firm actually decides to follow, fearing any implication. I don't know. Maybe like you can have a situation where you have a fund manager in a, I don't know, Korea,
pode falar em português, viu?
Yeah, we can switch to.
Porque não tem nenhuma pessoa, nenhum estrangeiro aqui.
So let's formally end and continue the conversation. So thank you very much. Well, let's continue.
Thank you a lot for being here and for